So when you're looking at buying a house, a lot of people understand that there are different kinds of loans. And we've talked about FHA, conventional, USDA, and VA loans. But there are other loan types, depending on what your situation is, that can be available and can be used. So Joe, tell us a little bit about what some of those are.
Well, so the four that we just mentioned are your most common, right? There's jumbo loans. There are balloon payment loans. There are also bank statement loans. So with bank statement loans, believe it or not, it's based off of your bank statements, right? So requires more. Usually with getting pre-approved, we just ask for your most two recent bank statements. We'll be asking for more on that one. But if you are like self-employed, or that can definitely be a benefit to you for sure.
So a lot of people that are not regular 9-to-5 type of workers, so they don't have maybe the income is commission based. So they're salespeople, maybe they're contract employees, some truck drivers, real estate agents can have a much harder time getting those traditional loans, because there might be a month where, gosh, you might have, a whole bunch of income, and then the next month you have very, very little because of sales, right? So that's where a bank statement loan can be very helpful, because you're going to look at what, 12 months, 24 months?
24 months, yeah.
Generally,
2-year average.
To see that, okay, yeah, so July is always a slow month for you, but man, March, April, May, you've got the money coming in. August, September, the money starts coming back.
Right.
So we know that cash flow is there.
Yeah, absolutely. And I mean, like you were saying, 24 months, what we'll do is take a 2-year average, unless your most recent year is less than your prior year. We'll still need those 24 months, but in that instance, you have to go with the lesser of the two amounts. So tricks of the trade, probably don't even necessarily need to know that, but the more important thing is you'll have to have documentation for the past 2 years.
Now, will you have to have a better credit score to be able to do a loan like that, or average credit, normal credit, like you would for other loans?
I would say average credit. You're probably the nice thing about credit is that the better your credit score, the better rates you're offered. So if you want to be paying as little as possible, which everyone should, you'll want to have a decent credit score.
So somebody, I'm just going to throw out a number, 700 credit score though, and they're not a W-2 employee, not an hourly employee, but they have consistent income from whatever their job, they make knickknacks and sell them, whatever that might be. They can go this route. How are they going to know if that's going to be better than a traditional, conventional, or FHA type loan though?
So realistically, we'll have a conversation and kind of look into the context and see just what the best option is. If it's going to be not worth the song and dance to be monkeying around with 24 months worth of bank statements, then, maybe we save that for if we absolutely need to. I always try to put people in USDA, FHA, conventional, just because those are the easiest ones for people to get through, right?
Sure.
But if that's not the case, if we can't do that, then let's exhaust all of our options. So if you want to buy a home, come talk to us.
Yeah, there are options. I mean, again, you mentioned balloon payment loans, which probably not a very good option for most people.
No.
But that is an option. You mentioned jumbo loans, which is more of a specific kind of loan for a higher end home, higher end buyer.
Yes.
But, those people are out there.
Yeah, and the difference between standard and jumbo changes per state, but usually I think Kentucky's about 650,000. So
yeah, it definitely has gone up the last few years, but it does change, and the terms are a little bit different as well with those. So again, you're going to want to talk to Joe if that's your situation. There's also ARM loans. What exactly is that briefly?
So an ARM loan is an abbreviation for an adjustable rate mortgage. So we were talking about a HELOC and how that is an ARM loan technically, but an ARM loan, the mortgage rate or the rate you're paying adjusts based off of the terms of the loan. A lot of times it's your first 5 years it stays the same, your first 10 years it stays the same, but then after that it can adjust to what interest rates are in that at the current time, right? And it can adjust significantly or it can adjust a little bit. Just depends on Just depends on the terms of the loan.
And that does mean it can go up or down.
It can go up or down. Yes. More often than not, it goes up though.
So if somebody were to do an ARM loan, though, and in 5 years, man, it's going up, can they refinance that loan?
You can refinance that loan. Yes.
So you can maybe if you've got the cash flow, you've got the savings, you've got the credit, you can have a situation where the ARM loan might be best now because you can actually start with a little bit lower rate generally.
You can start with a little bit lower rate.
But because it's adjustable, it's going to go up. And I only know that offhand because I just had a client who did one of these. And while most people were paying like a 7.5 interest rate, he got a 3.1 ARM loan.
That doesn't sound so bad.
All right. So for 3 years, it was going to be one rate, and then 1 year it was going to go up to another rate, and then it was going to be whatever market was. But while everybody else was paying 7.5, his 3-year rate was like 4.75,
Right.
and then the 1 year was going to go to 5.5, and then it would be market. And he went in with the whole plan of, I'm going to use this for those 4 years, and then unless rates are down below 5.5,
Right.
I'm just going to refinance into something else. So again, I'm not the lender. I just happen to know that because I just did one.
That's exactly what I would.
But that's a very unique situation, and most people are not going to want to take that kind of risk.
No, you're really planning on a refinance, and that strategy is what more often than not happens with the balloon loan as well.
Yeah,
you're planning on refinancing before.
And because the dangerous side of that is what happens if rates were to skyrocket even more than they did
Right.
the last year or so, and you go to refinance, and God forbid it's like 12% now or something, that could be a problem. Do we think that's going to happen?
No,
Probably not. But if we had the crystal ball and could tell you for sure, we wouldn't be making these videos. We'd be in Vegas.
Right.
So just know that there are different options. Joe can go over those options.
Yeah, absolutely, guys.
And others. There's actually many types of loans.
Oh yeah. So
many. I saw a list, and there's like a page of just different types of loans.
Right. People think 15-year and 30-year also.
Mm-hmm.
You can do a 22-year if you want.
Yeah.
So there's,
I did a 20-year loan on my home.
Yeah.
And so it's definitely doable. So it might be the same kind of loan, just different options. But there are also specialized loans for sometimes police officers, firefighters, nurses, doctors,
Hometown heroes,
vets. I'm actually not a vet, but for some reason I got on their mailing list, and I get offers all the time for a veterinarian loan.
Oh, so
not vet like
okay.
Service members, vets like working with animals. Every month I get this thing, get your veterinarian loan for your home. Wonderful, but I'm not a vet. So all sorts of different kinds of loan programs and options that can be available. And again, if you got questions,
513-907-2530. Devin, how about you?
859-962-7978.
Awesome. Thanks so much, guys. Talk to you soon, Hope.
There we go.